Welcome back, investors. I have a dividend ETF that I think you will enjoy, and no, it is not SCHD like every single YouTuber post. This is my channel, Trading Simplified. If you like what you see, go through the channel, check out the playlist, and also check out the WAP if you want to invest with me. This dividend ETF, SCHY, is going to allow you to diversify into international funds that offer dividend income. It tracks the Dow Jones International Dividend 100 Index, composed of high dividend yielding stocks issued by companies outside of the United States. When you buy SCHY, you are getting the exact same filter as SCHD, the most common dividend ETF you see on YouTube. But the difference is it is using the same exact screening process, except you are getting access to all international companies, nothing within the US. So the dividend consistency filter includes at least 10 years of consistent dividend payments. This automatically eliminates any speculative companies and any unproven dividend payers. And they also follow a financial strength ranking. It focuses on return on equity, which equals profitability, free cash flow to debt, which means they have a strong balance sheet, dividend yield, which is your income component, and then dividend growth rate, which equals sustainability. You're not just picking yield, you're picking high quality yield. Breaking down the portfolio composition, the asset classification is all international equity. When we focus on SCHY, we are only buying 132 companies. The top 10 companies below make up 41%. This includes BH Group, Ono Pharmaceutical, Roche Holding, GSK, Total Energies, and the list goes on. Now, North America, notice, is only 3%. You are diversifying your portfolio. You are buying international companies. 60% makes up Europe, 30% makes up Asia, Latin America 2%, Middle East, and then Africa. If you notice on the market capitalization, it's all giant and large, with about 9 to 10% in medium-sized companies. The sector exposure that you are getting is 13% financials, healthcare 12%, communications 11%. Let's take a look at distribution and expenses, and this is where the real magic comes in. If you look at the yield yearly, it's 3.57%, an excellent dividend yield. Your gross expense ratio, because it's passively managed, is only 0.08%, which equates to about $8 for every $10,000 you have invested. SCHY's inception date was in 2021. If you invested $10,000, it would be worth about $17,000 right now. If you look at the life of the fund, it has earned over 9%, and also in the last 3 years has gone up 18%. So should you invest SCHY in your taxable brokerage account or your Roth IRA? If you started with $10,000, invested over 20 years, assuming a 7 to 8% annual return, let's look at the difference between a Roth and a taxable account. In a Roth IRA, you would avoid all US tax on the dividends. After 20 years, you would have $42,000, assuming a 7.5% annual return. Now let's look at SCHY in a taxable account. The taxes applied would be 15% US dividend tax, and then you would also have the foreign withholding, which would partially offset by credit, which each year you would have to file with your accountant. This would cause an effective drag, 0.5 to 1% every single year. Your result after 20 years would be $36,500. So in your Roth IRA, your ending value would be $42,000, and your taxable would be $36,500, making a difference of $5,500. So you need to make the decision: do you have enough international exposure in your brokerage account versus your retirement accounts, and then compare which one is more important to you. At the end of this video, I'm going to include a link to SCHD if you want to compare that dividend ETF as well. And if you want to take this to the next level, be sure to click on the link wap.com/trading simplified, where you can discuss with me directly. I'll see you in the next video.